Hello and welcome to day 3 of our 30-day trading podcast journey. I'm glad you are here today because we are about to dive into one of the most essential topics in trading, that is the risk management. So what is the objective for today? To explain the critical role of risk management in trading, covering the key principles and the strategies for protecting the capital and avoiding the major losses. So if there is one thing every successful trader that has in common, it's understanding the importance of managing risk. It's easy to get caught up in the excitement of chasing profits, but without proper risk management, even the best trading strategies can lead to significant losses. In today's episode, we will explore the concept of risk management and give you actionable strategies to protect your capital, allowing you to trade with more confidence and consistency. So, I'll dive into these questions. So, what is risk management? Risk management is the process of identifying, accessing, and controlling the potential losses that come with trading. It's all about safeguarding your capital by setting limits on how much you are willing to lose on a single trade or over a given period of time. The idea is simple. If you can keep your losses small, you will have the opportunity to trade another day, even when things don't go as planned. Trading is absolutely and inherently risky. The markets can be unpredictable and no one can control or predict every price movement. That is why having a solid risk management plan is crucial to long-term success. So, why risk management is more important than the profit? A lot of beginner traders focus on how much they can trade with each trade, but seasoned traders know that minimizing losses is actually the key to staying profitable over time. Remember, you need to win every trade to be successful. That doesn't the case. You just need to protect your capital well enough so that your winning trades can outweigh your losses. So that means you don't need to win every trade. So let me give you an example. Imagine you are risking 50% of your trading capital on a single trade and the trade goes south. You would need to make 100% return just to break even. On the other hand, if you risk only 1 to 2% of your capital on each trade, even if you have a losing streak, you will still have enough funds to recover when the market turns in your favor. So the bottom line is, preserving your capital is the foundation of a good trading. If you are constantly taking large risks, it takes only one bad trade to wipe out weeks or even months of gains. So, what are the key risk management strategies? The first thing, using a stop loss order. A stop loss order is one of the simplest and the most effective tools for managing risk. It automatically closes your trade if the market moves against you beyond a certain point. Setting a stop loss ensures that you don't lose more than a predetermined amount on any given trade. For example, if you buy a stock at 100 and set a stop loss at 95, your trade will automatically close if the stock drops to 95. So, it will limit your loss to 5 rupees per share. Second, the 1% rule. A common risk management rule among traders is to never risk more than 1 to 2% of your trading capital on any single trade. This way, even if the trade fails, you only lose a small portion of your overall capital, leaving you with plenty of resources to continue trading. For instance, if you have 10,000 in your trading account, following the 1% rule means you would risk no more than 100 on any single trade. So, coming on to the next point, it's the position sizing. Position sizing is the process of determining how much to invest in a trade based on the level of risk. Large position means more exposure, while smaller positions reduce your risk. By adjusting your position size, you can control the amount of capital you risk on each and every trade. For example, if you are trading stocks, you might buy shares in low risk setups and fewer shares in high risk ones. This flexibility allows you to tailor your risk exposure to the specific trade you are making. Come on, diversify your portfolio. Another key principle of risk management is diversification. By spreading your capitals across multiple assets or markets, it reduces the impact that any of the losing trade or market downturn can have on your overall portfolio. Imagine that you are trading only one stock and that stock plummets due to unexpected news. If all your capital is tied up in that stock, your losses will be significant. But your capital is diversified across several assets. A loss in one area may be an offset by gains in another. Coming on to the next point, that is the risk-reward ratio. There is a simple concept that can help you decide whether a trade is worth taking. The risk-reward ratio compares the potential loss of a trade to the potential profit. A typical ratio might be 1:3, meaning for every one you risk, you aim to make 3. This ensures that even if you lose more trades than you win, your winning trades will still make you profitable in the long run. For example, if you are risking 100 on a trade, you should aim to make at least 300 in return. If the potential reward doesn't outweigh the risk, it might not be worth entering the trade. So, what are the common mistakes or the risk managements to avoid? Moving or ignoring the stop loss orders. One of the biggest mistakes is moving your stop loss order in the hopes that the market will eventually turn in your favor. Remember, stop loss are there to protect your capital, and moving them undermines their purpose. Stick to your plan and don't let emotions dictate your decisions. Over leveraging. Leverage can magnify your gains, but it can also magnify your losses. Over leveraging means borrowing too much capital to increase your position size. While this can lead to huge profits, but it can also wipe out your account if the market moves against you. Use leverage cautiously and in moderation. Risking too much per trade. Even if you are confident in a particular trade setup, risking too much of your account on a single trade is a recipe for disaster. Always follow the 1 to 2% rule to ensure that no single loss can dramatically impact your portfolio. Failing to diversify. Putting all your eggs in a single basket can be a little too dangerous. Even the most promising trade or asset can suffer from unexpected market changes. So diversification is a key to spreading risk and minimizing the impact of any single loss. So, risk management is the foundation of successful trading. By using strategies like stop loss orders, the 1% rule, proper position sizing and diversification, you can protect your capital and ensure that no single trade can jeopardize your entire account. Remember, trading is a marathon, it's not a sprint, and your primary goal should always be to stay in the game. So in today's or tomorrow's episode, we are going to shift gears and talk about something just as important, the trading psychology. We will explore how emotions like fear and greed can impact your trading decisions and how can develop the right mindset for consistent success. You don't want to really miss the next episode. Thank you for tuning in to day 3 of the trading podcast. If you are enjoying this series, please subscribe so that you don't miss any episodes and share it with anyone who might get beneficial from these insights. Until next time, happy trading. Thank you everyone.